Thank you, and a very good afternoon to all the attendees. In this session, I will be covering 5 topics mainly, and the first topic would be foreign tax paid. Now, the taxable person can net off any foreign tax which is paid in other jurisdiction against a tax liability in UAE. So currently, all companies are either writing off these amounts in the financial statement or either netting off the amount, netting off the income and reported in the financial statement. Now you need to change your accounting policy to show the amount as an asset in the balance sheet. And the amount that you need to recognize as an asset should be to the extent recoverable, and the balance should be treated as an expenses. Now law states that only 9% of foreign tax can be deducted. That means if the corporate tax paid in other jurisdiction was more than 9%, then the excess paid should be treated as an expenses in the books of accounts. You should also remember that the non-recoverable part is considered as an expenses, is not a deductible expenses for computing the taxable income. Now, provision for double taxation avoidance agreement between the countries is actually crucial in this one. And also you need to make sure that you have adequate supporting documents to substantiate that such foreign tax has been paid in foreign jurisdiction. Now, the second point is GAR. Now, this is covered under Article 50 of Corporate Tax Regulations. Now, GAR provisions are actually applicable from October 10, 2022. Now, what GAR says is, if any transactions or arrangements, if FTA can reasonably conclude that the action was not for a valid commercial or non-fiscal reason, and it does not reflect any economic reality, and the main purpose of this is to have a corporate tax advantage, they will consider this as a tax abusive and can take action against the company. So in the given example, if a company decides to revalue the properties and equipments in the books of accounts from 1 million to 2 million, and the idea is just to have a more depreciation during the corporate tax era, this will be considered as an anti-abuse. Now, company decided not to charge depreciation in the books of accounts in the current period and charge when there is corporate tax. That will also be treated as tax abuse. Now, there is some income which need to be, which is actually accounted in the books prior to the tax period, so that this income can be deducted in the corporate tax era. So all these adjustments will be treated as tax abusive, and FTA will charge penalty on you. So you need to take care and make sure that you don't do anything in the books of accounts in order to have a corporate tax advantage later. Now, the third section, in these slides, actually, we will guide you how you need to take care of various accounts in your books of accounts before you close the financial year prior to the first tax year. Now you are into 2023, the first financial year for Gregorian calendar year companies. Your first financial year will start from January 24 to December 24. So in 2023, you have to make sure that you follow all these principles. We will start with properties and equipments. Now, first, the company should set a threshold above which a qualifying expenditure will be treated as a fixed asset, and below which it will be charged as an expenses. Now, company should maintain proper FA registers. By FA register, what we mean is you should have a register which contains the detail of acquisition cost, accumulated depreciation, depreciation expenses, date of acquisition, etc. Now, regarding the rate of depreciation, law does not specify any rate to be used. However, you have to ensure that the rate which you are using commensurate with the useful life of the asset. We are expecting that there may be a cabinet decision which specifically explains what rate you have to use for depreciation. Now, regarding the ownership, in most of the companies, we have seen that assets recorded in the books of companies are actually either owned by the shareholder or by the related party. And these cases will be questioned by FTA. So now in 2023, you need to plan about changing the ownership to the company name or remove such assets from the books of accounts. And when you remove the assets, you have to remove the related expenses as well. Secondly, regarding intangible assets. Nowadays, we are seeing that companies are capitalizing intangible assets in the books of accounts. Mostly staff costs are being allocated as the intangible asset. You should make sure that you have adequate supporting documents to substantiate the figures that you are capitalizing. You should also make sure that future economic benefit will flow to the entity. And you should also have documented evidence to substantiate the income generating capability of the intangible asset. Now, you should ensure that the intangible asset that you are capitalizing is genuine. So there is a chance that companies can decide to capitalize the intangible asset just for the purpose of having a benefit, amortization benefits in the tax era. So it is to be noted that in other tax jurisdiction, mostly those authorities does not allow amortization as an allowable expenses. And in the UAE corporate tax, they have not mentioned anything regarding that. So we believe that they will allow it, but scrutiny will be very high in the intangible section area. Regarding the rate of amortization, similarly for properties and equipments, law has not specified any rate. However, you should make sure that the rate that you're using should commensurate with the period through which the benefits from the intangible asset is being earned by the company. In this case also, we expect that there may be a cabinet decision which explains the rate to be used. Now, regarding the ownership of these intangible assets, we have seen cases where these assets have been recognized, but when we asked about the supporting documents, most of the companies does not have proper documents to substantiate the ownership. Like for software, there should be copyright registration. And most of the cases, these documents are not available. So at least in this year, you have to check the legal regulatory framework for your intangible asset and have to make sure that you have adequate ownership for those intangible assets which is recognized in the books. Now, regarding investment in shares, first thing what we have to do is we have to identify the cost of investment, and the value of investment should be at fair value. So you have to have adequate supporting documents to substantiate the fair value which you arrived at is correct. Now, regarding the gain or loss, you have to identify the unrealized gain or loss and has to account it separately. Now, why we are asking you to account it separately? Because this unrealized gain or loss is not a deductible expenses. So you need to create a separate ledger for realized and the unrealized portion so that adjustment to the taxable income can be arrived at easily. Now, similar to properties, in investments also, we have seen that there are assets which is held in the shareholder's name or is held in the name of related party. So you have to make sure and you have to do all the corrective measures in 2023. Now, regarding investment properties, you have to ensure that the investments are held in the company name itself and not under the name of the related party. Some of the properties we have seen, particularly in some cases, that the ownership of the property which is recognized in the books is in the name of shareholder. So you have to take care and do necessary adjustments to correct this. And also the valuation should be done at fair value, but you have to have adequate supporting documents to ensure that the fair value that you stated is correct. Now, for property, we advise you to do the independent valuation at least once in 3 years, and the rate to be used for the amortization should commensurate with the useful life of the asset. Now, regarding inventory, as per standard, it should be valued at cost or net realizable value, whichever is lower. But for slow moving inventories, it is advisable that you create adequate provision in the books of accounts. And it is advisable to maintain a proper fixed stock register which shows the movement of inventory. And also, it's better that you do a physical verification of the actual inventory in your warehouse. And if there is any inventory missing, it's better that you write off this from the books with the proper management approval. And you should have a documented inventory policy, and the documented inventory policy can state conditions such as storage, insurance, valuation, allowance for slow moving, who authorizes the write-off of inventory, who authorizes the missing inventories, like that. So it's better to have an inventory manual which specifically states all these conditions. Now, the next portion is actually trade receivables. Regarding trade receivables, you have to make sure that the receivables are actually actual. So you have to take the list of receivables and check whether these are actually recoverable. And if not, you need to write off this from the books of accounts in 2022. Regarding doubtful debts or expected creditors, you are supposed to create adequate provision. But you have to think this law is not very clear whether this provision is provision will be treated as a deductible expenses. So in most of the other tax jurisdiction, this is a non-deductible expenses. So we need to wait for further updates on this. So however, anyway, as per accounting standards, this has to be computed, but whether it will be an allowable expense or not, further we have to wait for a cabinet decision. Now, any receivables which is stated in foreign currency, you have to revalue it at the rate published by the central bank. Now, with regard to trade receivables, we would like to address another issue wherein we have seen cases where the receivables from the customers are being collected by the shareholder, and there may not be any documents to substantiate this. And also there are cases where customers are directly settling to the suppliers. So those sort of transactions will land you in trouble. These may be questioned by FT. Now, regarding the other receivables and bank balance, regarding bank balance, we have seen in some of the books of accounts, the bank accounts are held in the name of shareholder, or maybe held in the name of related party, and you need to organize all these transactions. And our advice is not to mix all these transactions. And even if the company is using the company's bank account for the personal purposes of shareholder, better remove those from the company records. Now, for prepayment, now if the company is having any expenses which is enjoyed in 2024, so better you provide you create adequate prepayments in the books of accounts in 2023 financials. Regarding advances and advances, staff receivables, like that, for all those items you can create adequate provision. You have to ensure that whether it is collectible, and if it's not collectible, you can create adequate provision for this. Now, regarding FD, why we specifically included this one? Because some cases we have seen that the company is having FD in the books of accounts, but interest on it is not accrued because the company does not know the interest until they get a bank confirmation or some other information from the bank. So you have to make sure that you create adequate accruals in the pre-tax period itself. Now, in all these cases, either for receivables or the banks, if these balances are actually in foreign currency, you need to make sure that these are revalued at the closing rate published by the central bank.